let's get more reaction to today's move higher in the markets. Joining us is Tony Dwyer, the Chief Market Strategist at Canaccord Genuity. Tony, great to have you with us.
Great to be with you, Mel.
What's your interpretation of this rally?
So I think it's just a reversal of what we saw in the prior 2 days. Like, for example, I was looking before we came on, I was looking at the BKX, which is the KBW Bank Stock Index, which is exactly where it closed on Friday. In other words, there was kind of an inappropriate anticipation of this massive blue wave that had lifted all the cyclical stocks. And that was just reversed with today's decision. I think today's, or lack of decision, the election to me, and the reason that the market went up more than anything is it took out the extreme tail risks. Because the House, actually, the Dems lost some votes, and the Republicans kept, it looks like they're going to keep the Senate. That takes away your massive tax hikes, which are, of course, the negative anti-business, unfriendly policy. But it also takes away, to what the panel said, it takes away the massive stimulus that the market was anticipating in the prior 2 days. So to me, it just neutralized what was going on before it.
So what does neutralization mean for the market's trajectory, Tony?
So Mel, as you know, I'm bullish, and I'm bullish not in the next 15 minutes. I've proven I'm not the greatest trader of all time, as I always say. However, if you've taken out the tail risk, what are you left with? You're left with low inflation, ultra easy Fed for as far as the eye can see, excess liquidity to a historic degree, and a synchronized global recovery, the beginning of a synchronized global recovery. So our view is, because you've taken out some of the political tail risk here, I think you want to use any volatility that presents itself to kind of attack risk, meaning get into risk based on that excess liquidity and global growth rather than fear it.
Hey, Tony, it's Tim. Thanks for joining us. So help us now with the macro, because the presumption was that the dollar was going to go lower and rates were going to go higher. What are you expecting with the dollar that even before we really started pricing in blue wave was actually showing that it was running out of some steam? And what do you do with the rates markets? Because these industrial trades, some of these resource trades, I think are still very much in play.
Oh, I think they're absolutely. Timmy, you had an inappropriate run up 2 days before an election that was totally uncertain. The time to add risk wasn't this past Monday. It was after the rally. It was when you only had 5% of the S&P above its 10-day moving average, and the VIX spiked above 40 last Wednesday, right? So I don't think there's any change in our outlook. We are in a weaker dollar framework over the course of the next 3 to 6 months, which means emerging cyclical small cap and commodities. Now that was consensus Monday when some people downgraded tech and upgraded cyclicals. I don't see any change there. We're going to be a little bit more volatile until we figure out who's going to be the president. But ultimately, as I wrote today, the most powerful person in Washington, D.C., it was Ben Bernanke, then it was Janet Yellen, and now it's Jerome Powell. And we're going to get his news tomorrow.
So Tony, hey, it's Dan, bud. So you just mentioned the tail risk. It sounded like more of like a political sort of situation. Wouldn't you say that the other tail risk is just the second wave? We see Europe shutting down. We see that we might take more aggressive mitigation attempts here. I don't think we'll do lockdowns or anything like that, but without further fiscal stimulus, isn't the risk here that we just see a dramatic slowing in growth? And then you look back to 2019, the S&P 500 had no earnings growth, but went up 30%. This year, we're going to have negative earnings growth, significant, down, 15, I don't know, 20%. And we have a market up 7%. So what does that leave for 2021 without a major fiscal stimulus bill?
Well, first, Dana, it's a great question. I think you will get fiscal stimulus, but let's look at the difference between the prior shutdown or lockdown from the COVID-19 and today. If you remember back in February, we had downgraded the market in January because there was this risk that was unidentified. You didn't even know what COVID-19 was. You didn't know what it would do to the economy, and we literally shut it down, not slowed it down, not opened up, for outdoor dining, shut it down globally. And you didn't know how the Fed was going to react. Since then, we've raised almost $1 trillion in corporate credit new issuance. Companies have extended maturities. They're borrowing. Everybody is borrowing money at historically low rates. That's what's driven the excess liquidity that can get us there. And that's the difference from that prior instance when we didn't know if there was going to be liquidity. There was no access to money, and the government forced a shutdown.
Tony, always good to get your thoughts. Thank you.
Thank you, Mel.
Tony Dwyer, Canaccord Genuity, and I think this is sort of the conundrum that the markets have, Guy, and that is the notion that liquidity and that low rates, low inflation, all that can offset the potential slowdown that we could see ahead for us in the economy because the stimulus package may be long in coming. It may be months before we have it. It may be smaller than we need, et cetera. And there's a pandemic, by the way, still going on.
Yeah. That's been the game, right? And the only time the really market's had a hiccup outside of a few events has been when the Fed has signaled that they really want to pass the baton from monetary to fiscal. The market hasn't liked that all that much. And quickly, because I think it's worth pointing out, Tony mentioned something about the huge run-up in some of these industrial names. It was either last night or Monday. The time sort of escapes me now. But Karen spoke to exactly that, if you remember, with URI. She was questioning as to why URI had rallied to the magnitude that it did. Didn't make sense to her. And then you see a name like that down, I think, $24 or $25 on a day like today. So there were a lot of weird things going on leading up to this. My concern, just sort of, you want to talk about tail risk. The president has been very outspoken that if Joe Biden were to be elected, the 401ks would all be devastated. We'd be on the verge of, you pull out the other, recession, depression type thing. If the market were to rally, when it becomes at some point potentially clear that there's going to be a new administration, there's some serious tail risk associated with that if you start to do the calculus in your head. That is very concerning to me.
Shepard Smith here. Thanks for watching CNBC on YouTube.